However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind. Okay?
Got it. Okay. Now, moving on to tax strategy number 2. We are in a very good economy until about 2 weeks ago, right? Maybe about a month ago. That's when the stock market started to crash. A lot of people here in the Silicon Valley have stock, appreciated real estate assets, if you will. Okay? So you go, all right, 2020, the sky's falling down. Okay? Now I want to get out. I want to get out of this real estate portfolio, my stock portfolio. I have accumulated so much gain, but I have to pay like a big chunk of money in taxes. What should I do, Susanna? Right? So I have some suggestions for you. Okay? So now you're the seller, and you have a real estate portfolio. You also have a business that you started 30 years ago. For those of you who have a business, whether it's a high-tech business or a family business or what have you. And then you also have stock, mutual fund, RSUs, what have you. In this case, let's just say we're looking at just real estate. You bought this house, $100,000 years ago, okay, maybe 20 years ago, and it's now worth $1.1 million. Okay, if you were to sell it today in 2020, you have to pay $230,000 in taxes, capital gains taxes. Okay, capital gain tax is now at 20% federal tax rate. Okay, and combined federal and state tax on the capital gain, you'll be paying 23%. All right, given if you're in the top income tax bracket right now, which is 37% for federal. So now, there are 4 ways for you to not pay capital gain tax on this appreciated real estate. Number 1 is the Deferred Sales Trust, or DST. Number 2, you could use CRT and a wealth replacement trust. CRT stands for Charitable Remainder Trust. Okay? You could actually combine number 1 and number 2 together. Okay? So they don't have to stay as separate transactions. You can actually do a Deferred Sales Trust in addition to CRT and wealth replacement trust at the same time. Your choice number 3, your option number 3 would be to do an UPREIT, okay, under Section 721. And then your next option is to get rid of your appreciated property in an installment sale. Like I said, each option has its own pros and cons. This webinar is to show you the alternatives that you haven't thought about before. Because most people, when they have appreciated properties, what they do is especially real estate, what they do is they would call up a local real estate agent and they'll say, okay, I want to sell this property, right? And they just pay the tax. And then the following year, when they come to me and file their tax return, they are shocked. Susanna, why is it I'm paying so much in taxes? I said, well, I'm sorry. I mean, there's really nothing I can do, because when you were contemplating selling this property, you should have given me a call so that we can do some tax planning for you. And this actually happened to a few of my clients who have real estate portfolio. They pay taxes up to their nose, right? And by the time they see me, because remember, tax planning is not something that people think about, number 1. And number two, not all CPAs are created equal. A lot of CPAs, they only do tax reporting. They don't do tax planning, right? And so it's important if you have real estate portfolio, and especially for those of you who have a business or multiple businesses, multiple mutual fund brokerage accounts, appreciated stocks, assets in general, it's important that you are in communication with your tax CPA before you pull the plug and get rid of your property, because they can actually save you a lot of money in taxes. So for me personally, I can help you make an assessment of all four solutions and give you an independent advice. In other words, I'm not selling deferred sales trust. I'm not selling CRT, 721, installment sales. I'm just going to show you, okay, here are your choices. Here are the pros and cons for each choice that you're going to make. This is the tax cost to you. This is your tax benefit. You decide, right? So I'm here to coach you along the way. All right, so what is DST overview? We don't have time today to go into each and every single option, you know, the pros and the cons, okay? I'm just going to give you an overview. So these are the steps. A trust is set up by a law firm. A trustee is then be appointed by you, the seller. The trust then buys the assets from you. The trust then liquidates the asset by selling it to a third-party buyer for cash. And then the trust pays you a stream of income over time. Simple, right? Well, it's not simple because there's just a lot of nitty-gritty details that go into that, but that's the big picture. Number two, CRT and wealth replacement trust. So these are the steps. Number one, you donate the asset to a newly created CRT, shareable remainder trust. For those of you who want to leave a legacy behind to a nonprofit organization, and I have a lot of clients who like to do that. As a matter of fact, I have a client who has been getting 60 grand in pension money, right? That is just a portion of their income. They get pension income, 60 grand from one of their pensions. And what they do every single year is they would endorse the check and send it over to their church, a nonprofit organization. They do that every single year. They do that, right, every single year. So, and they don't have a CRT, by the way. All right, so in this case, you donate your asset to a newly created CRT, a trust, shareable remainder trust. And inside the trust, you will write a clause that says, when the second spouse passes away, the remaining balance of the trust goes to one or more designated charities. In other words, you can still enjoy the income inside the trust when you are alive. But when the second spouse passes away, all of that money will go to the Red Cross, the XYZ, the church, what have you. And then at the same time, you would set up an ILET. An ILET is an irrevocable life insurance trust. Okay, I call it a wealth replacement trust. And then what happens is you will cause this ILET to buy a life insurance called a survivorship life insurance, or second to die. Okay, so that is to help your heirs pay estate tax using life insurance money to pay for estate tax. So this is a combination of the CRT and the ILET, right? So there are two trusts going on at the same time, okay? Now remember, it's a very complex tax planning idea, right? So if you combine this idea with the idea before the DST, whereby you also have a trust, so now we're dealing with like 3 different trusts, okay? So this is how the super wealthy, the people with money, deal with their legacy planning, right? And they pay a lot of money to have this idea put in place for them. but it's available. All right. Number 3 is the Section 721, aka UPREIT exchange. So basically, you're as an investor, you have a building or a house, appreciated property, okay? And you no longer want to manage that property. It's too much headache. You know, you're near retirement. You don't want to deal with tenants and toilets, but you still want to have a predictable stream of income. So what you do is you would put your property, you contribute your property into a partnership, this REIT right here, in exchange for their operating partnership unit, aka OP unit. Okay? And then this REIT over here, REIT stands for Real Estate Investment Trust, right? It's a trust. And it has a lot of real estate holding portfolios inside the trust, okay? They may invest in single family homes, they may invest in shopping centers, they may invest in office buildings, and all kinds of things. Okay, so in a way, this REIT is like an equivalent of mutual fund in real estate. Okay, and then in return for the property that you are contributing into this REIT, you're getting back the REIT shares. Okay, and then the REIT here has to distribute its income every single year back to its shareholder. So that's how you get your return, your stream of income annually from the REIT. And you don't pay taxes on the contribution of your appreciated property to the REIT. That's just the law. That's how they're written. When you, as a partner, contribute your appreciated asset into a partnership in exchange for the partnership interest, you do not recognize a gain on that contribution of the appreciated asset. And that's the law. I mean, I didn't make that up. And if you want to read it, you can Google IRC Section 721, and you can read all about UPREIT. Okay, last but not least is the installment sale method, okay? And this is extremely simple, but not many people actually utilize this strategy. Number 1, you sell an asset to a buyer in exchange for a promissory note. In other words, you are acting like a bank, okay? That buyer, instead of going to Bank of America to borrow money to pay you off and buy your property, you become the bank. They promise to pay you back that money. Your name is on the deed. So if they default on the mortgage note, you take the house back. Make sense? And then you hold the note until it's paid off by the buyer. And of course, there are many little details that goes into, well, how much interest should I charge this buyer, and what is the duration of the note? Should that be a 5-year note, a 10-year note, a 20-year note, 30-year note, 45-year, 50 years? What is it, Susanna? Well, that's when I can come in and help you determine what would be a reasonable terms for you to live, right? Some people, they would not be comfortable holding a note. I'm comfortable holding a note because I really like it. You know why? Because if this guy, and if it's the right buyer, if he doesn't pay the mortgage, and as a bank, I have the right to evict him and take the house back because he's at default in his mortgage, right? Okay, so what is a reasonable amount, the duration of the note? I say, like, if I'm retired today, and if I think I live until like 140, because I've been telling all my family members I want to live until 140, like healthy, okay, like not sick but healthy. So if I'm 50 today, that would be like 90 years, right? Yeah. Okay. So I want the note to be like a 90-year note. How about that? Why not? Because I don't want to pay all the capital gain tax now. I want to spread it out over the next 90 years. And when you spread your gain over a 90-year period like that, what you're playing is the time value of money. In other words, let's say if you owe, in our earlier example, if you have an asset that for which you paid $400,000 and you sell it for 1.1 million, you have to pay $230,000 in capital gain, right? Okay. Now, instead of writing a check of $230,000 to the IRS and to your state in 1 year, the money could have been invested in something that could grow 7% per year for the next 90 years. Okay. Right. So instead of writing that big check, I'm going to tell the IRS, okay, look, IRS, I'd like to pay this $230,000 in the next 90 years. If I live until 140, that is, right? But I am going into this transaction with this buyer knowing that this is how long the note is going to be for 90 years, okay? So if 90 years is too much for you to handle, let's talk about a reasonable duration. How about 30 years, right? 30 years. Yeah. A lot of mortgages out there are for 30 years, right? Okay, 30 years. So now I'm able to spread my $230,000 tax liability over 30 years. Why is that important? Because $230,000 today is worth a lot more than $230,000 in the next 30 years. And when you are in the installment sales strategy, you're basically buying time, right? You take the money that would otherwise go to the IRS and you invest in something that would grow more than what you're getting over here from the buyer, hopefully. Your picture, you being the audience or people in the audience who are real estate investor, okay? Because I have seen clients of mine who have made a lot of money in W-2 income, okay? And they make lots of money in W-2 income and they start investing. And guess what they invest in? They invest in real estate. Okay, awesome. And what do they buy? Well, they buy right here in the Bay Area. Well, you know, when you buy in the Bay Area and you do not buy right, when I say buy right, I mean you buy low, you sell high, and you buy in a way that your rental income is greater than your rental expenses. That's how you consider whether or not you have bought right or not, right? When I was a real estate investor, my emotion was pretty much detached from the property. I mean, I don't care if it's beautiful or, you know, location, you know, whatever, right? I look at that piece of property as an asset and I run my numbers very, very objectively. Okay. If the numbers don't make sense, I didn't buy anything, period. Okay. I would walk away from the deal. Who cares, right? Because I'm looking for a money making asset. I am not buying money losing asset. That's the bottom line. That's my philosophy. A lot of people have a different philosophy. They are betting future appreciation. It may happen, may not happen. Who knows, right? But that's beyond your control, right? So now when you rent a piece of property and your income is so high and you happen to buy in an area that would generate tax loss for you, you cannot take that loss on your income tax return. Ouch. So that unallowed loss, I call it passive loss, will then be carried over into the future. Okay? And it will continue to be carried over for as long as you keep that property. So imagine you have this asset, you put some down money. So let's say if you buy $1 million property, you put in $200,000, and every year you have $20,000 loss. Okay, and it's been going on like that for the past 10 years or so. So now you put in $200,000 to buy this property. This property used to be worth $1 million. It is now worth, I don't know, $2 million. I don't know, right? I mean, if you buy it in a really good area like Los Altos or Palo Alto, you know, your money could actually double in a very short time, right? Given that you get rid of the property in time before the market crashes again, who knows? The real estate market may crash. I don't know. I hope not, but who knows, right? I mean, we already saw what happened to the equity market a month ago, right? It went down like that. Nobody expected it. So the real estate market could follow. Who knows, right? Okay, so you have accumulated about $200,000 of losses during the last 10 years of you holding this money losing real estate, right? Every year you lose $20,000, and you have put in $200,000 as a down payment. So in total, your investment in this property is $400,000 plus opportunity cost, right? Because if you didn't lose money, you could have used the money that you have put into this real estate of $200,000 and 7% or 10% during those 10-year periods. Okay, and so so I go, well, Mr. and Mrs. Client, what are you planning on doing with this property? I mean, are you thinking of maybe retiring inside this property when you retire? When are you going to sell it? You know, what is your exit strategy? And most of my clients have no idea. They have no idea what their exit strategy is going to be, right? Because that's not what they do. They're not a real estate investor, like professional real estate investor. I mean, they just happen to have some extra money on the side. They have a great job paying them, you know, a lot of money, and they don't know what to do with the money, right? And so they buy real estate. And so that's where my value comes in, is to ask them prompting questions like that so that they can start thinking, okay, well, is my money working hard for me? If it hasn't worked hard for me, well, is there a better alternative? Okay, and let's sit down and discuss what these alternatives are, okay? So now, if you find yourself in that situation, okay, your real estate is an investment. It's not a trade or business activity. Now, why it's important to make the distinction between investment as it relates to your real estate asset versus trade or business activity. And I will explain to you why. Okay? Because if your rental is being classified as a trade or business activity, these are the tax benefits that you can get. Number one, you're going to get a tax favored Section 1231 treatment. I'm going to get into what that means, okay? You get to claim a home office on your tax return. If you can demonstrate to the IRS that your rental income is a trade or business, I call it T or B, instead of an investment. Make sense? Number three, all the meetings that you go to, all the seminars that you go to, and the conventions that you go to learn how to invest real estate and run a business in real estate, all of that is a tax write-off. If you are a real estate investor, no, you cannot write off your meetings, your seminars, your conventions, all of that. Because I know a lot, 10 years ago when I started getting into real estate investment, I went to a lot of meetings. I went to a lot of seminars, and I also went to a lot of conventions. I shook a lot of hands, right? Got to know people. If I got myself into a classification of investment, and none of that would have been a tax write-off. Okay, so just be careful. And then, of course, when your rental is a TOB, then your assets that you buy to operate that business could be a Section 179 tax write-off. In other words, you can write off instead of depreciating that over a number of years, depending on the life of the asset that you're buying for your rental asset. So is that clear to all of you? So that's the reason why you want to make your rental a TOB and not an investment, okay? Sometimes it works, sometimes it doesn't work, and we have to look at legal entity structures, and it depends on the area. Like I said, and in some situation you want to call your rental real estate an investment, but in some situation you want to call it TOB, right? So it depends on the situation. Again, it depends on your situation. But for the purposes of our discussion today, I'd like to show you how you can actually take a home office deduction if you're a real estate investor, okay? All right, so what's the definition of trade or business, TOB? So there are a bunch of tax court case laws out there, okay? Number one, Levi. In this case, the court ruled that the trustees of the estate, by renting the real estate, were engaged in a TOB. Just being a trustee, okay? You're renting out the real estate inside this estate. Well, guess what? The court said he is in real estate TOB, not in real estate investment activity. Number two, in ELEC, okay? So this is a taxpayer who used to live in Hungary and purchased an apartment building in Hungary. And then he left the country to come to the US. He then appointed his father to become the manager of that apartment building. And then during this time, his apartment building was nationalized, okay? And because of that, he lost money on his building, on his investment. So he claimed a business loss as opposed to a capital loss. And the court agreed with him. The IRS came in and said, nope, we think you did your tax return wrong. It should have been a capital loss, not an ordinary loss, business loss. He fought the IRS. They went to court, and he won, okay? Jepson. In this case, the court ruled that George, the taxpayer, had a business. In other words, his activity, rental activity, was T&B. When he bought a house to rent, and he listed it for rent, and then he showed it to prospective tenants to rent it, but then he never actually rented it. I mean, that's all he did. He bought a house with the intention to rent. He actually listed it for rent. He showed it to the prospective tenants, but then he never rented it. In that court case, the court agreed with him that his rental business is not an investment. It's actually a T or B. In the Hazard case, the taxpayer moved from location A to location B. In this case, location B is in Pittsburgh, Pennsylvania, okay? And it happens to a lot of us, when we retire, we sell our house in California, we move to a different state that has zero income tax, whether it's in Florida, Nevada, Washington State, what have you, okay? He then listed his former residence for sale and also for rent. So he did both, not just one. He listed for sale, and then he also listed for rent. He then rented the house for about 3 years while listing it for sale. And then after 3 years, he sold it at a loss. And then even though in the court papers, there was no mention whether or not he actually actively managed the property while it was rented, okay? So the court didn't even care if he actually actively managed the property. They just said, well, nope, we agree with our taxpayer. He was in the business of renting or running a business. He was not investing in a rental real estate, okay? So now if you happen to have a house, and I know my clients, I'm not going to review names, okay, who have bought houses back in 2008 and 2009, okay, 2010, 2011, 2012, in Detroit. Okay, there were a lot of promoters selling houses in Detroit, and they promised my client that they would manage their houses, their rental properties in Detroit, and they would make money on their income. And I think these houses in Detroit costed, I don't know, like 10 grand a piece or something, 15 grand, like super, super cheap, okay? And they went into the deal. And until this day, 2020, the house has not appreciated. Not only that, they actually lost a lot of money because every time a tenant would move in, they destroyed the house. They moved out. They got another tenant in. The next tenant destroyed their house. They put in new cabinets, new floor, right? They destroyed the house, kicked them out, put a new tenant back in. It's madness, right? It's crazy. But they don't want to sell it because if they sell it at a loss, that's a capital loss. And as you know, if you have a capital loss, you can only deduct $3,000 of losses per year against your income, right? So they're like, and they buy a lot of houses too, right? And so in that situation, if they have a W-2 income, okay, and if they do not make their real estate activity a TOB, then yeah, definitely, they're not doing any tax planning, right? They're not doing that, okay? But if they come to me and they ask me, Susanna, is there a way for me to make this capital loss into ordinary loss? Like, how do I do that, right? I'll tell them, hey, look at hazard case right here, right? Maybe that's something you can do. You can list it for sale, but you still rent it or something, right? So you make your situation mirroring what's being proven in court as a precedent, right? You create your own situation mirroring what's being done here previously. Most likely, you're going to get the same tax treatment. Does that make sense to everybody? I hope so, right? And so there are a lot of court cases out there for real estate investors. And it's important for you to talk to a tax CPA who could do research and who could actually put together a memo to back up that research in case if there is an audit, you have something to fall back on. So the bottom line is that you got to look at the court cases and you have to make a judgment call. In the tax laws and tax regulations, the IRS doesn't say, okay, you have to do ABC in order for your real estate activity to be considered a TOB, right? So it's not like that. It's not a bright line test, okay? Now, if your real estate activity is a TOB activity and not an investment activity, you can take a newly created deduction that came about in 2018. It's called a 199A deduction, right? So you can look it up, you can Google it, right? But that's a 20%, depending on your AGI. If you operate this rental business as a sole proprietor or as an S corp, and all of that. But that is available to you, okay? Now let's just say that your activity somehow does not meet the TOB definition, okay? You could use what I call a commonly controlled rule. And based on this definition, a common controlled rule is this: the same person or group of persons directly or indirectly owns 50% or more of each TOB. Attribution test: spouse, children, grandchildren, and parents would be treated as such. What do I mean by that? All right, so we have a husband and a wife. The husband is over here. Here's a wife. And pardon my drawing. This is the best I can do. The husband owns an S Corp that runs a retail business. It could be any kind of business. It could be a retail business. It could be a fast food business. You know, doesn't matter. It's a retail business that requires to pay rent. The wife owns a building. It doesn't have to be like an 18-story building. You know, you can imagine like a small building, right? Commercial building as an investment. And the wife makes $500,000 as a VP of a company, right? So this piece of building is her investment, right? So every year this office building does not make money, she cannot claim the loss, right? It becomes an unallowed passive loss being carried over year after year after year, okay? The husband rents from an unrelated third party, maybe his landlord, okay? So in that case, her rental business is not a TOB. It's an investment, okay? Now, they come to me and they go, hey, Susanna, this is what we've been doing. Do you have any ideas? Like, how can we make this better tax-wise? I'll tell them, hey, look, husband, why don't you rent her building, right? So the wife would rent the building to the husband as corp. So even though this building is not a trade or business, but because in this case, the husband, okay, has a retail business, therefore, this rent is now considered a TOB. Because why? Because both the husband and the wife control this business, retail business, through the attribution rule I mentioned earlier. Make sense? So even though the husband has an S Corp in which he's a sole shareholder, the wife doesn't do the retail business. This is all she does, right? She's super busy. She doesn't have time to do this, She's lucky to even have time to go out there and look for an office building or some kind of investment to buy, and that's all she can do, right? But because she has rented this building to the husband's business, and the husband's business is an active business, therefore, under the tax laws, through attribution rule, she, together with her husband, owns this business or being seen as operating an active business, trade or business, and not an investment. Therefore, this rental activity here, the money that she makes from renting out her apartment or her space or her office building to the husband would qualify for a 199A deduction. Okay,